So there, it looked like it was spinning.
Yep, we're getting started.
There we go.
All right, Vanessa, we're in good shape?
Okay.
All right. Everybody good to get started?
Yes.
All right, we'll call to order this May 25th, 2021 meeting of the Lawrence County Retirement Board. Would all please rise for the pledge of allegiance. On the side, Sarah, would you lead us in the pledge?
Pledge allegiance
To the flag of the United States of America, and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Now please maintain for a brief moment of silence. Thank you. Vanessa, please call the roll.
Controller Gettings,
Here.
Treasurer Rapone,
Present.
Commissioner Spielvogel,
Here.
Commissioner Vogler,
Here.
Commissioner Boyd.
Here. We have all members of attendance on note for the guys on the live stream. You can see 4 members here. I'll note we put Treasurer Rapone, he's in the corner right now, he's in timeout. So if you can't see him, he's sitting off to the side, he's not allowed up on dais.
I think in fairness to our treasurer, it should be noted, he voluntarily chose to sit there. Am I right? Or did they send you over there?
Although that we are being live streamed, it's being broadcast out to our viewer. If that viewer wishes to make a public comment, then they do so by sending comment to mboyd at lawrencecountypa.gov. That's mboyd@lawrencecountypa.gov. Please include the subject line, retirement board public comment, and will be entered into the record. Will also be recorded internally for our purposes of compiling the minutes. That being said, are there any public comments today? Around, I'm not seeing any. Minutes, we have two minutes, one from our January 12th special session and one from our February 16th regular session. I'll give approve the minutes or make any additions as you said be necessary.
So moved.
Second.
All right, a motion is second. Is there any discussion? Hearing none. Question on the motion. All in favor, please signify by saying aye. Aye. All opposed, the same sign. Motion carries. With that, I will turn it over to Sarah for any new business and an update for the board.
Good morning. It's nice to see everybody.
Good to see you.
Especially without a mask on.
Yes.
Be able to see your expression. Just a little bit of an update. If we look at Exhibit 1, I always like to say tab 1, the market update. Even though it's been a pandemic, we've been growing. And one of the things that we have decided to do as we consider counties as our specialty, we're actually developing a YouTube channel that counties can come in and use to educate their employees. So there will be, something on the pension plan, something, how many years does it take to be vested. So we'll try and do that, some education on the markets and things. So we're just in the beginning of developing that, but we thought that's something that we really can see a benefit to you as our county clients. The other thing is Somerset County just became an OCIO client last month, so that was exciting as well.
Congratulations.
Yes. Thank you. Let's talk a little bit about the market. We're going to look date since last Friday. So we looked at the U.S. economy, and it's actively accelerated in the first quarter with real GDP increasing by a strong annual rate of 6.4 and a continued strength in consumer spending and policy support. And if you look at that graph below, you can see, look where it was this time, actually almost this time last year, and then look how it's gained back in spending. So most notably, our rising commodity prices and a tight global supply chain has driven rising input costs for both manufacturing and service firms. And we are really seeing that. I mean, if you go out and look right now in the housing market, and if we're building a house for $150,000 in a week, that house build would be $174,000, just the rise of everything. And then, going to the gas tank right now, if you see that, is just, it's pretty there. So then we talk about rising inflation expectations for parents in the TIPS market, where the 10-year break-even inflation on the 10-year treasury note less than the yield on the 10-year tips, and it's the quarter at the highest level since 2013. And we know tips are what you can go in and buy, and that's to be a hedge against inflation.
What's the acronym for TIPS? Is it an acronym?
It's Treasury Inflation Products.
Gotcha.
That would just jumped my thing. I will come back to me in a second. But tips are, what they do is they index to inflation. So they're really, you can use them thinking about inflation. But, when we talk about inflation, we're going to start seeing rise of inflation. We expect to. But the Fed's still saying they are not going to do anything with rates as of now till 23. Increasingly interesting, the 5-year break-even inflation is higher than the 10-year break-even inflation. So we look at where that is below. Look at short-term interest rates on the bottom. And we look at that and we can see the future markets are expecting them to go up slowly in the next 12 to 14 months. If you turn the page, you can look at the global economy has continued to grow. Economic recoveries, however, are beginning to converge across countries and regions depending on the success of vaccine rollout and policy support. While all major countries and regions saw their economic growth estimate upgraded, many marginally, particularly those experiencing another wave of COVID. So we look at Europe and Brazil. Now, if you look at that graph below, you can see, look where the US is. As of January 2020, it was 5.1 for the US. Now we're looking at the end of April, 6.4. So we've really started to see this. That's largely because of the vaccine. Now we still have, we haven't seen the aftermath yet of COVID. There's still going to be a difficulty with what's going to happen with all those mortgages. We're going to look at what's going to happen with, real people not going back to work. So companies are actually slow to open. Some are closing because they can't find enough workers. They're going to part-time.
What's the fluctuation on the OECD composite leading indicators? That fluctuation is that COVID? Is that just
That's COVID. So look, that was May 20th to March 21st. So that was the COVID fluctuation.
That's pretty
And it was almost like the market too. I mean, we saw such a fluctuation with everything, especially globally. And then if you go look at the next page, and I'll talk a little bit about that. This is from 3/31, 2020 to 3/31, 2021. US equities were up 62.5%.
It's amazing.
And that is why you always stay within your asset allocation, your investment policy, because you really don't know. I mean, it was hard to, say at the end of March and where you were, those returns were looking pretty poorly. Now, you benefit, we'll talk about that in your performance.
Are all the bonds up because of inflation concerns?
Yes. And the bonds are actually, but we did put high yield in for you, and that was actually positive. And that even though it was a little percent, but yeah, bonds are negative right now. And that's amid a sharp rise in the treasury yields. And then we look at global equities, globally rallied in the first quarter. And then we talk about US equities. And when we've seen US equities, we turn the page, they've actually come back to value. So, we always have a little bit of a value tilt, which does better in down markets for protection. And we look at the run-up in the equities have driven valuation measures to the upper bounds of historic ranges. So what does that mean? One of the questions is, where do you put your money? Well, there isn't really anywhere else to put your money, so you're going to still continue to put it in the equity market. We certainly acknowledge that the stimulus measures have kept interest rates low, provide ample liquidity, and undoubtedly pushed investors into equities, thus continuing this run-up in equities. We know eventually it's going to change, but really there's no alternative. So with rates so low, investors have nowhere to go. And the term is further supported when examining the equity risk premium, which compares the S&P 500 earnings yield to the 10-year Treasury yield. The premium remains solidly positive. So with market fundamentals are positive, strong earnings as a result of a broader economic recovery should help support this market this year. We can look at the U.S. equities, look at how the rollover, look at consumer discretionary, 98.4% return. And that's a large part is when you look, nobody was shopping at the end of March, and we were basically in shutdown. And then you've had all these stimulus packages and people went out and bought a lot of things with those. All sectors finished the quarter in the black, with more cyclical, as I said, was outperforming. And then we turn the page and we look at the U.S. equity market, and then we look at quality. So actually quality was down. From a market perspective, value led the way, following the strong relative returns for yields, low volatility besides. Value was the best performing segment of the U.S. equity market in the first quarter. It was up 21%.
But as we look at growth down 5, but growth had a terrific year last year. So,
Growth had a terrific year for the
it's-
last 3-4 years.
It's amazing. I mean, even though you're down 5, growth is still up in the 20s and 30s in some of those years. So we did tremendously well. Now value is holding it together good. That means that the market's not falling apart. But at the same time, as we look at where we're at, this particular year, the first 4 months this year, 3-4 months, it's just crazy months. It's just a very
Keep on saying,
unusual.
it's a very unusual market, and it's very unusual times, because you go and you look at thinking after pandemic, how, with this vaccine, nobody really knows, hopefully it's gonna work, we only have 60% of the United States vaccinated. You still have kids that are too young to get vaccinated. Hopefully they're out of school. So you really do have, people are on the sidelines saying, what else could go wrong with this? And you also have, and I keep student loan debt. The student loan debt is astronomical, and those defaults are going to come back.
But here's the question, as the market continues to stay volatile, and as the inflation will continue to rise, if there's a change in the tax rates, the market can tumble
Yes.
very, very heavily. Now, I don't know where the economists are in relationship to the they're talking about things that will really put the dampers on the market in the 3rd or 4th quarter this year, or the 1st or 2nd quarter of next year.
And I think that's why, the diversification, when we look, real estate, it's going to go up this year. We look at, where JP Morgan sees real estate, and it's going to go up, especially in times of inflation, it will go up there. So, that diversification, I think, when the market goes down, everybody runs to fixed income. So you're not going to have double-digit returns. We know that. We have, prepared you for that with this kind of portfolio. But yes, you're right, it could turn. Last January, I thought, we were due for a correction within 18 months. Here we are. Now, we did see a lot of volatility in the market.
We didn't have the spending we have now. We have trillions and trillions of dollars worth of spending that our kids, grandkids, and grandkids are not going to be able to pay back.
Well, somebody's going to have to pay back all these stimulus checks. It helped the economy for now, but, looking out 20, 30 years, yes, that could be a huge burden on the economy.
20 or 30 years is not my real perspective at this point. Looking at a 30-year perspective, a 5 or a 10-year perspective is definitely something that concerns me.
Right. I think when you look at, we look at 10 years, we try and annualize, and we'll look at it with the performance. In 10 years, we want to meet your actuarial assumption. That is the goal. So when the market's up 30%, you're only up 28.5%. It's when the market is down that we want to be able to protect the portfolio. So we know it's coming. We just, take the good years. We just don't know when. And, you know, if the market, when it happened in 2008, we just went down, you know, one of the things, the actuaries came out and said, okay, now we're gonna do the smoothing, you know. So if that happens, believe me, there's another smoothing formula we have to do to.
The interesting part about it is we look back now when we took and fully funded the plan, was it ago? That looks better than it, we've not done it now, because now we've lowered our rates. We've come down to a point where I think we're at 6.5, Dave, is it 6.5 or 7?
I think it's seven.
We dropped at least 0.5%, and we're now overfunded in the pension plan, which is good. I mean, there's very few counties that are in the position that we're in. But it was a situation that we thought it might work, and we lucked out, because it didn't work.
And by doing that, and lowering the 7% and, you know, funding that pension plan, you know, your ADC is also, within the next couple of years, is gonna be, you know, not as high.
Very low this
There's
year.
a county,
Awesome.
Yes, very
there's
low
a
this year.
county that
Even
had
he's
to
happy.
take a.
I would just never happen.
We're semi-happy.
There's a county that had to take a bond issue out so they could pay their ADC, you know. And it's, depends on, you know, who, how.
Coupled with that, Sarah, and I wouldn't expect you to name names, but I assume you have some county clients that, unlike us, are not fully funded, and I'd be curious to know, and again, don't name them by name, but where are some of their percentages in terms of their funding levels?
Actually, our counties are actually doing fairly well. You know, we're in the upper 80s% of counties. You know, what we have done with all of our counties when they've become clients for the long term is that, you know, there's a couple things that have really done well. We've seen the switch in the last 3 years over to OCIO, which you have as discretionary. So the county's not waiting. You know, can you imagine every 3 months doing a meeting and then having to make a decision? Different managers, the 3 different managers make that decision. So we're able to be very nimble. So when we look at that, that has really benefited at least our counties. I can say that you've got some counties out there that throughout Pennsylvania, I know are in some really are struggling right now.
Some in the 60s,
Mhm.
60th percentile,
That's what I would,
and some in the
Yes.
70s.
Yeah.
We're very fortunate. We haven't, but we have gone into, and not patting ourselves on the back. It's just, you know, it's been working with some great boards, educating, realizing what they can do, how to, you know, what's the best thing they can do in diversifying the portfolio, lowering, you know, the interest rates, changing the mortality table. So they keep trying to do something every year. You know, I have one county who can't lower the rate, but they changed the mortality table this year because, and they're very well funded, but they know, you know, how are we gonna do this with the EDC? How are we gonna do this with our budget? And I know last year, everybody has been affected with COVID. Taxes, you know, the budget, you know, there were furloughs in some of the counties we saw, so.
That was us. Question for you, though, going back to macro for a second. Do you think that, do you think the US economy in general right now is being held up by federal spending?
I think part of it is, there is a part of it that absolutely is being held up by federal spending. I think you also have a surge of people being able to spend again. So you're really gonna see that. You know, last year, the US savings, because nobody was outspending, went up drastically compared to where it was, you know, 5 years ago. And unfortunately, we're spenders. If you look at the economy, you look at the personal savings, we're spenders. You know, the 2 cars, the house probably is a little bit bigger than you should have, you know, everybody's credit card, and not everybody, but I'm saying is, in general, that
Yeah.
personal savings is not. But so there were people who went out, bought the big TV with stimulus, And there were people who actually saved it and did something with it.
I think the figure I saw was spent on consumption, with the remaining 58% being spent on either paying down debt or going into savings.
Right. So, I mean, that was a really good thing, and that's gonna help down the road. And you're also going to see, you know, in the next 2 years, you're gonna see people are gonna start traveling again. You know, think about the cruise industry, the airline industry, you know, I mean, they have suffered. And that trickles down to everybody.
Let me ask you this, where were we earlier on last year, maybe mid last year, we decided to make a shift to infrastructure. Is that accurate?
Yes, we've got you in the line to get into that.
Do we know when that shift will take place roughly?
Well, I was gonna talk about that. What we're gonna probably do in the next month is put you in a listed infrastructure that we can get you immediately into. And then while we're waiting on that, and we're gonna talk a little bit about, I've run an asset allocation, and we're gonna look at where that is and how we're gonna fund that.
Okay, the reason I bring that up is because, you know, the anticipation right now is in line with increased federal spending that we're seeing from the Biden administration, from the Democrats controlling both houses of Congress.
It is. And actually, when we do look at infrastructure though, spend a lot on infrastructure, you will see that that's a great investment. We actually look at infrastructure for like about a 6.5% to 9% return, you know, and 5% of that, I mean, it's gonna help, you know, it's gonna be more diversified. We wanna keep taking away from fixed income right now as much as possible. And we'll take some of the equity there, but we also look at when we make those decisions is to make sure that we're not adding too much volatility, and that's the one nice thing with infrastructure when we look at that.
Gotta fix the roads. Gotta keep the airports in check. It's always gonna be taken care of. Thank you.
You're welcome. Are there any other questions on the market? Do we want to see how we did? So let's go with the portfolio overview. Your market value at the end of March was 95.7.
You know what we're at right now?
Stop saying that. And Friday, close of Friday, we were at $98.3 million.
So
That is
we're
a-
encroaching $1 million.
It's an all-time high. For the first quarter, you returned 3.3, had a net investment gain of 31 million. For the trailing 1 year, you annualized a return of 32.9% and had a gain of 24.2 million. For the trailing 3 years, you annualized 9.8 and had a net investment gain of 24.4 million. Remember, you're taking out all your benefits too, so that's a wonderful return. And I think this is the most important. Since inception, since February of 2014, so 7 years ago, you've annualized return of 8.5. That is right on where you want to be. So you've had some down markets in there, you've had a negative market, you've had a flat market, you've still done 8.5, and you had a net investment gain of $44 million.
Refresh my memory, that date, the 2/1/14, is that when you folks came?
That's when we came in. So that's what we measure that by.
Thank you.
Remember, that means in 7 years, we've met the anticipated rate of return and exceeded it on the average.
Yep.
Yes.
Now, I will note that over the 1 year, you see we're down to about $2 million in net cap, but $2 million left to fund. So in other words, we can see the effect of Frank Carey retiring.
Jan's gonna affect that too.
That's good. There's another 2 mil.
So yes, you've met your actuarial assumption, and that has been, you know, with this board, you know, really made some great decisions on diversifying over the last, you know, you've done a lot of work, and that's really paid off.
One thing that's most important about that item is, remember, when our interest rate was 7.5, our unfunded liability was being paid that interest rate of 7.5. We structured the bonds at 3 point was, I don't remember the exact number. So we've gained almost 5% over what we would have spent, 4+ over what we would have spent, which is huge amounts of dollars in that period.
Right.
On an annual basis.
You actually did, when you did that pension, you know, there was a lot of dynamics going into issuing a pension. on, and some of our clients we don't feel are in a good fit to do that. You guys were in a great fit, you also took that down and you were able to do that, so it really made sense at that time. And you're right, you've done very well with that.
Because of the up market, we've done better.
Right.
I mean, we still would have done okay even if the rate was 4, but at this particular point, we're above 4.
So equity composite returned 6.1% for the quarter, and for the trailing 12 months, it returned 53.7. The US equity was up 7.6 for the quarter, global 3.3, the international 4.9. We continue to see a style and market cap shift in the first quarter as value stocks outperform growth stocks and small cap stocks outperform large cap stocks. The US fixed income returned, it was negative for the first quarter by 3.5, but you were still up 1.9 on a trailing 12-month basis. High yield manager, and this is really how you benefited. They returned 1.8 for the quarter, but the trailing 12 months, we did 28.2% on that. And we put in, and then we kept on buying them slowly, and then we adjusted back down too. So that was something we knew was a short-term play. You normally will not see that from us. You know, we are long-term looking at investments. COVID, obviously, with that market, we saw that those yields, high yield was the way to go in there. And that comes from having 33 research people in the company.
That's
Yes,
exactly
Lord
right.
Abbott.
Did they merge with Costello? I'm sorry, that was a joke, and I don't know if anybody got it. I got it, but I got it.
It took me a minute longer, but I got it.
Right here.
Oh my gosh.
Would that be 1? Sorry about that.
You should have said Lady Costello.
Yeah, Lord and Lady, yeah.
So, also, we added Baird Aggregate Bond as an active core bond manager. Added, emerging markets equity position with Fidelity Emerging Markets. We transitioned from Vanguard Total International Equity to Fidelity Total International Equity to reduce the management expenses by 5 basis points. We're always trying to do that as much as possible. There you can see you're well in on the next page, you're well in your policy range. And you know, we look at the 1 year, you returned 32, you were slightly off from your benchmark, and we knew that that was the first quarter. I mean, when we looked at what happened there, 5 stocks leading the way, 495 weren't. It was just so much volatility. So you did well. It's just that we knew that quarter was, as we talked about, was a tough quarter. And then if we turn all the way to
Question, I'm looking, we have no contributions in the first quarter.
Off of page 2.
Average for 3 years, $25. We really went overboard.
I think because don't you put the contributions into general fund?
We're gonna check.
Oh, that's
We're gonna
right, okay,
check
that's
that.
right. Oh, that's right. We put them in, so we're taking them out of the.
Right.
Just thinking out loud, $25 seems a little bit off, but no.
Kind of administrative that came back. Out of crediting.
That's a good point. I hope it was administrative. I hope somebody didn't sit down in a room.
Page 7. A little bit managers. When we look at that, so you can see when we look at your American funds, Washington Mutual did 8.6, but for the 1 year did 49.5%. We look at Eaton Vance Small did 66.1%. And then we look at your global managers, MFS Low Volatility is 32.9% for the trailing 1 year. And then we look at Bonneville Global, which did 46.5. And we look at AB Global Core Equity, did 6.7 versus 4.6 for the benchmark, so they outperformed. And then we look at Hartford Schroders, did 8.6 for the quarter. They also did 52% there. And then we've added the Fidelity Total Index and the Fidelity Emerging Index Fund. So we'll be able to see where that's going. Done well, outperforming since the inception, 1.6 versus 1.4. And the inception was February when we added those two. So I want to give you a little bit more diversification on in the non-US equity composite, but we also dedicated an emerging manager. So we thought the best way to do that right now is through an index, because we couldn't find somebody that was an active manager that made sense for the price and performance. We look at real estate, and real estate did 1.6, Morgan Stanley, and then Clarion did 2% for the year. We know JP Morgan, we went back, we did 2 conference calls, and we were on with JP Morgan during COVID. They had a couple pieces of with JP Morgan during COVID. They had a couple pieces of real estate that they just went down, took a hit on. And then what happened was everybody got in this massive panic on real estate, and they all decided they wanted to take their money out. So there was, they were selling to pay for that, because they have, if you get in the queue to sell, it's 1 month. That is the one thing about that fund. So they had to do it. So that was where they've come back. We're very comfortable with where they're at. Real estate is, so they're looking good. Clarion did 2%. And then we look at US fixed income. We look at really what helped you there was obviously Lord Abbott, your high yield. It did 1.8 and it did 28%. We look at fixed income for the trailing 12 months did 1.9. And then we're probably going to see those returns like that. So really the diversification everywhere else is really going to help you. And even though real estate is a little bit low, we look at real estate in the long term, 5 to 7%. But it's just a nice steady eddy. Are there any questions? And right now, total fee, even with all the diversification, you're at 36 basis points. So that's very low, considering, it's not just indexed. We've got some nice active managers in there.
The equity composite. Is that percentage of fund, or is that percentage of just US equities?
On the total equity
Yeah.
composite?
Yeah.
That is your percentage of the total equity composite. So that's all of your managers,
Okay, but just in the equities.
just in the equities.
Okay.
Are there any other questions? Well, that's it.
Great.
Okay.
I'm very happy.
Could you repeat that? Could you repeat that, please?
I'm very happy.
Make sure we have that recorded.
You'll never get that, it is very rare to get that one.
I was gonna say,
Good.
Not you specifically, the company wide.
I did notice that there was a promotion in the staff of a gentleman named Morgan. I was just curious, I didn't know there were that many first name Morgan individuals. Morgan Chase.
Mm-hmm.
So Morgan Boyd, it was a promotion.
We've really done a lot of hiring. We just hired a performance analyst in the Westchester office, a research analyst in the Westchester office. So we've really added a lot of, we've added 4 staff members there. We've been adding staff, even though they're not, some people haven't even been in the office yet, are hired via Teams and, doing that. But we will really continue to grow. And one of the things that we can put a lot of money into is research. And that is why we have 99% client retention. It's not just from service, it's from the research that we put.
How's Michael Schoen doing?
He's doing very well. This is gonna be his
Last
last year. So it's an interesting transition for him, I think. He went back to school, he's getting a master's degree and, he's doing all sorts of things. So I think he'll still have his fingers in something. I just don't think it's this, but he's doing very well and he's enjoying 2 grandchildren.
Good for him.
So that's
That's
very
great.
nice for him.
Before we wrap up, I do want to note that when we, at the beginning of 2020, the county's contribution to the pension, I think we had budgeted $1.3 million. And through the changes made by this board and through the performance of the fund, which is a testament to the management of the fund through Marquette, that contribution this year, I want to say is under $300,000, which is
85 or something like that.
is phenomenal
Yeah.
for the county's financial position. So that's a testament to Marquette and the job that you guys have done managing the fund
Absolutely.
throughout all the volatility of the past year, as well as I'll pat all of us on the back right now, but as well as a testament to the I think the management of this board. So let's keep it up and let's keep that contribution down.
Most importantly, the retirees of Lawrence County can be rest assured of the fact that the fund is secure, the fund is good. Now, whether we will be doing a cost of living in the future will be determined at the time, but, we are definitely making responsible choices relative to the plan moving forward.
Any further comments from any member of the board?
I think
Nothing from Siberia?
I move we adjourn.
We have a motion, do we have a second?
Second?
We have a motion and a second. Any further discussion? If none, question on the motion, all in favor, please signify by saying aye.
Aye.
All opposed, same sign. Motion carries. Lawrence County Retirement Board is adjourned.
Are you coming to CCAP in August?
I am. I'm actually going to the Treasurers Conference. And I turn around and go to the Allegheny League of Municipalities.
You're going to
Conference.
Good. Hopefully.
I'm doing some fun stuff on CPAC. I don't have any, so
We'll see.
I'll ask this.
Oh, we're still on. Do you have a moment? I had something